Hello everyone, my name is George Wong. I am a junior in the Marquette University Applied Investment Management program, and I will be pitching Nexstar Media Group, ticker NXST. Nexstar Media Group is the United States leader in local broadcasting with a 68% household reach, not including the UHF discount. Nexstar provides local communities with critical, unbiased news. It began with one television station in Scranton, Pennsylvania, and now owns, programs, and/or provides sales to 198 stations nationwide. Now a little bit more about the company. Perry Sook founded the company in 1996 and took it public in 2003. It is headquartered in Irving, Texas, and is a part of the communication services sector. It derives revenues from 5 segments: core advertising, political advertising, distribution fees, digital, and trade and other. Political advertising accounts for less than 1% in non-election years. Now a little bit more about the stock. At the time of pitch, it is priced at $113.84. It has a market cap of $4.86 billion. Its 52-week range is $43.37 and $130.12. Its 2020 estimated revenue is around $4.5 billion. And below that is a 12-month price chart. It is recommended that Nexstar Media Group be added to the AIM Equity Fund with a price target of $138.08, representing a potential upside of 21.29%. Nexstar became the largest local broadcaster through strategic acquisitions of stations across the United States. In fiscal year 19, it acquired Tribune Broadcasting, which not only gave Nexstar local stations, but also equity positions in 2 national cable networks, 31% in TV Food Network and 100% in WGN America. From fiscal year 19 to fiscal year 24, its revenue is expected to increase at a compounded average growth rate of 13.6%. With duopolies in several markets and a pending Supreme Court case likely to allow Nexstar to own more stations in a single market, the company will be able to increase shareholder value and increase its margins. My first investment driver is Nexstar being the industry leader in U.S. household reach. Being the leader in U.S. household reach has given Nexstar the opportunity to demand fair and favorable distribution and advertising rates. With its large reach, Nexstar can negotiate advertising agreements with national advertisers like auto manufacturers and fast food restaurants, which is uncommon among local broadcasters. In several markets, Nexstar has a duopoly and is able to cut the cost of programming and give advertisers more options to target specific groups. With local news witnessing slight increases in viewership, as shown on the right, Nexstar is in a favorable position to capitalize on increased advertising and distribution spending. As mentioned before, the anticipated Supreme Court decision in June will likely benefit Nexstar, as they will be able to add more stations in existing markets, which will provide opportunities to cut programming costs and increase margins. From fiscal year 19 to fiscal year 24, Nexstar's operating margin is expected to increase from 21.56% to 27.99%. The next driver is strategic M&A. Nexstar has grown through mergers and acquisitions, and at the end of fiscal year 19, it had its largest transaction ever, the merger with Tribune. This deal brought many local news channels to the company, along with equity stakes in the Television Food Network and WGN America. Through decreases in fixed programming expenses and corporate overhead costs, and increases in distribution revenue, this transaction resulted in operating synergies of $185 million and an expected EPS year-over-year change of 196% from FY19 to FY20. Earnings per share growth is expected to continue at a rate of 12.1% until fiscal year 24 as more operational efficiencies are recognized. Nexstar's additional distribution revenue brought in by the transaction is important in quarter 1, as it is usually a down period for the broadcasting industry. With this transaction, distribution revenue is estimated to continuously grow at an average year-over-year rate of 8% until fiscal year 24. Additionally, Nexstar's smaller transactions throughout the years of buying and disposing of local stations across the country have increased its reach and operational efficiencies. My final driver is operational realignment. Recently announced, Nexstar will consolidate two of its business units, Nexstar Digital and Nexstar Broadcasting. This move recognizes the need to have more digital news and for it to be delivered more efficiently and effectively. As a result of this realignment, Nexstar believes digital engagement and awareness will increase, which will further increase Nexstar's lead in unique users across the local news app category. Its digital revenue has grown over 145% since fiscal year 15 and is expected to grow at a compounded average growth rate of 6% until fiscal year 24. This operational realignment will not only maximize Nexstar's reach and content, but will also result in 7-figure direct operating expense savings in fiscal year 21. Now for Nexstar's valuation. Nexstar has a weighted price target of $138.08, representing a potential upside of 21.29%. A 5-year discounted cash flow model was constructed and a price target of $145.09 was found. Using a discount rate of 5.73, a terminal rate of 1.25, and a beta of 1.56. To the right is a sensitivity analysis on the discount rate and the terminal rate. My price to sales relative valuation gave a price target of $114.54. My EV to EBITDA valuation gave a price target of $140.59. Both relative valuations, the price to sales and the EV to EBITDA valuation, were both given a 20% weight, while the DCF was given 60%. Again, Nexstar has a weighted price target of $138.08, representing a potential upside of 21.29%. Now for investment risks. Social media as a news source. Social networking services such as Twitter, Facebook, and Reddit are rising as sources of news for many American adults. The rise of social media services providing news to users may impact the number of television watchers, which may disrupt revenue. The next risk is economic downturn. Because advertising spending largely follows the movement of the overall economy, any slowdowns would negatively affect Nexstar's revenue. With core advertising expected to represent 35% of total revenue in the upcoming years, it would be directly impacted by an economic downturn. Another risk is cable contract negotiations. Nexstar must constantly renew their contract with major cable providers, which has led to carriage disputes. During these disputes, Nexstar's networks are blacked out for the provider's subscribers. Any dispute after a contract's initial renew date may cause advertising revenue to decline. Management at Nexstar has been a key to its success, and the team is full of individuals who have many years of experience in the broadcasting and media industry. Its founder, Perry Sook, has over 39 years of experience in media and broadcasting. Tom Carter, its president, COO, and CFO, has over 35 years. Karen Brophy, Timothy Bush, and Sean Compton, all presidents of their respective division, have over 15 years of experience. Nexstar's board of directors consists of Sook and 8 independent directors who have experience in media and television broadcasting. One of the 9 members is a woman. To conclude, Nexstar is a sustainable industry leader with room to improve. With rising revenues and improved margins, Nexstar represents a unique investment opportunity. If you have any questions, please feel free to reach out, and thank you for watching.